don't have a better explanation than most other people on exactly what's happening with the 10-year, but what I can tell you is this. I think we're going through three big transitions in the market and as investors. The first of which is that we're moving from the first half of the year to the second half of the year, and I think there's going to be a clear division in the two, and that's going to be characterized in the second half by a search for catalysts. So that's what we're looking for right now. What's the next catalyst? The second big transition is that we're moving from rebound to recovery. We've now rebounded to prior levels of GDP, prior levels of earnings. So now we're searching for where does that new growth come from? We don't have an answer to that yet. And then the last one is that we're moving from momentum to fundamentals, and investors need to search for durability. This is a transition. Transitions are never smooth, they're never easy, and we're probably going to continue to chop around here until we figure out what that next tailwind is.
Okay, so Josh Brown, let's cut through some of the noise, right? Let's move beyond this one-day move. Cut through the noise, which you're so good at doing. And I just bring up that conversation I had yesterday again with that large money manager said, don't take any of this in the market as some sort of signal that growth is peaking, that the move is long stocks, yields are low because of where all the liquidity is. The liquidity is not going away anytime soon. Get this noise out of the way. Tech's going higher. Stocks are going higher. Who cares if rates are where they are? It's for a specific reason. Move on. Thank you very much. What do you think?
Well, I guess a couple of things. The first is raise your hand if you've been a successful investor by making inflation predictions short term over the last 10 years. Oh, I see that no one's hands are raised. This is not literally how to allocate a portfolio. That's one. Two, the Treasury market does not do a good job at predicting inflation. Bond traders are no better than anyone else. The Fed's not good at it. So this idea that the 10-year is this clarion call for where inflation is going is kind of foolish. What we know, looking back at long-term history, is that the bond market systematically has overpriced the rate of inflation for very long periods of time, and it's also underpriced it. And a really great example, from 1981 to 2007, systematically the bond market thought inflation was higher than what it actually was. It wasn't until 2007 that reality set in. So people expecting the 70s went from 1981 for another 26 years overpricing inflation, and all you have to do is plot CPI versus 10-year yield. So we should stop this game immediately. What the Treasury market does well is price in longer-term inflation, not yesterday's CPI report. Okay? So that's not a winning game for investors. I think big picture, the NASDAQ just went up 6 straight weeks. That's a lot. It's up 14% year to date. So seeing these tech stocks pull back, basically from all-time highs, seeing the semis take a breather, seeing the FANGs take a breather, there's nothing wrong with that. That should happen. We saw the Qs down 1.8% at the lows this morning. Now they're only down about 1%. There's not a lot of damage there. Last thing, REITs. Unbelievably strong. That should not be happening if we think interest rates are, if we think 10-year rates are about to crash to the floor. REITs are green today, almost all of them. Staples are barely down. So I think we have to divorce this idea that the bond market is, quote unquote, telling us something about economic growth. It's never done a good job at that in the very short term.